What is up, guys? I hope you're having an amazing day. I got some insane information I'm going to share with you about Google today that I'm sure you did not know about. But before we get into the earnings and the valuation and some red flags, which is why I'm not buying Google right now and I don't own any Google, but I'm sure you do not know about this, the other bets of Google. So this is updated Q3 earnings report right here, where Google makes money and how much money they make. And this is what I'm talking about. The other bets that generated $0.4 billion and cost them a loss of over $1 billion. Now, there's about 5 companies that Google owns that I'm sure people don't know about, such as Waymo, Verify, which is about life sciences. But there's 2 that are insane that I did not know about. So first one is Waymo, autonomous vehicles, and the second one is Wing, a drone delivery company. So I'm gonna dig into, let's talk about a little bit about drone first, and then we're gonna get into the Waymo. Wing is an Australian company owned by Google, and it's been around since 2019, based in Australia. And in 2024, they started their expansion in the USA. We can see that they made 30,000 deliveries in partnerships with Walmart. So they pretty much come and pick up the things from Walmart and drop it off to your house. And it started in Australia, and they have over 250,000 residents through partnerships with local merchants like DoorDash. Now, this is insane. So many people have a job of just doing DoorDash, Uber Eats, where they manually drive and pick up the order. And now we got Wing, Google's company, that can pick it up for you and deliver it with a drone. That is just next level. And if we look at what their plans are, we can see that they're working on the efficiency side of it, making it more profitable and efficient. So right now, I don't know how many pilots they have and how many drones they have, but they're working so they can have one pilot working on their computer, manage 50 drones simultaneously at the same time. Insane. And they're on track to do millions of customers by mid 2024, which is already passed. So they have been around. They're doing great things. And we can see the partnerships with Walmart already cover 75% of the households in Dallas. And the best thing is, Wing isn't just in the USA. Like I said, they're in Australia, they're in the United States, Finland, Ireland, and they have future plans of going into the United Kingdom. And I believe they're going to take over the USA and enter a lot more cities and a lot more countries. The other bet is Waymo. Now, I think this has even more potential than Wing. This is autonomous driving. This is what Tesla has been trying to do and are saying they're going to have robotaxis by 2026. But Waymo has been around since 2009 as a part of Google. And in 2016, they made it a separate company, but Google still owns the majority of it. So how this works, Google's capital expenditures, the investments into their business, is going to be $50 billion this year. And $5 billion, or 10%, is going straight into Waymo. So I believe they see the potential in this and have a lot of faith in it. Just in 2024, they reached where they did 100,000 paid trips in just 1 week. And we can see that next year, their revenue is supposed to grow 109% to $180 million. They're only in a couple cities right now: Phoenix, San Francisco, Los Angeles, and Austin, but they are currently testing in 25 different cities in the US. Now, robotaxis are not a simple thing, and there's a lot that goes into it. Right now, they do have 700 vehicles, and in 2009, they started with the Chrysler Pacifica minivans. So they would use that, and they would put all their gear, and Tesla only uses cameras, but Waymo uses these radars and all this other cool technology that helps them connect to Google Maps, which they have so much data in Google Maps, and that's what they help make it easier and take the right routes. Because I know when I use Google Maps, I can see when there's crashes, I can see when there's red lights, and all these cool things. But the Chrysler didn't work out, which I'm surprised. It's an American company. I thought they would take an American company, but then they went to Jaguar. These Jaguar SUVs, they would load them up with their gear and use them. They ordered, I believe, 20,000 Jaguar SUVs to use as their fleet, but they have changed their mind. So in the future, they have already made a partnership with Hyundai. So Hyundai is going to make these electric cars, the Ioniq or Leoniq 5 electric vehicle, and that's only going to start being used in late 2025. Now, before we get into what's wrong with Waymo, look at this. They have partnered with Uber. So in all of these cities right now, when you go on Uber, you can choose Waymo as an option, and a car with no driver is going to come. You press, I'm here, I see the car, and the door handles just pop out, and you open it up, and it's all cool. You should check out some of the videos. But let's get to the bad stuff. Bad stuff, it is not very profitable, and it is expensive. These Uber rides from Waymo cost even more than other rides, which is just ridiculous, and that's why it's not as scalable as it should be right now. And the main problem is with this is that even the Hyundai dealership, the Hyundai company that they're going to work with, they're going to get their cars from something from $70,000 to $100,000 per car, which is just extremely expensive. When you look at it, Tesla is going to be selling their robotaxis for, I believe, $30,000 a car. And if you could look at Baidu, I made a whole video about them. They're doing this robotaxi thing big time in China and have already 500 active fleet cars in their fleet. And I believe they pay around $30,000 per car. And if Tesla's selling it for 30,000, they're gonna sell it for they make it for even less. So this is the disadvantage of Google. They don't have their own car, they don't have that expertise, and they don't make it from scratch. But either way, I think Waymo is going to stay around and just grow. And I think that's just an insane thing. And I'm really excited how they're going to use that $5 billion that Google just put them on. All right, let's zoom out and take a look at the big picture. So what is Google? Google is a tech company, an AI company. And we can see that the Google Cloud right here generated them $11 billion, which is up 35% over year. And we can see all their revenue segments are up double digits year. The ad revenue 10%, Google Play subscriptions 28%. We can see that everything is up. And Google Cloud up 35% year is the most interesting one, and that's where 90% of their investment is going to the AI infrastructure. Right now, Amazon is the biggest player in the cloud AI space. They own 31% of the market share, and Google is third with 12%. Everyone is hopping on it. Alibaba has their own cloud. Baidu has their own cloud. They're all investing so much billions of dollars into these data centers to handle more information and just scale it. And for the right reasons. We can see that the AI market itself is growing at a CAGR of 35%. And if we zoom into the AI cloud sector, it is growing at 36% year. So this is just an industry that's growing so quickly, and more use cases are coming out. And I believe this is something that everybody needs to invest in. The easiest way to do it is just buy QQQ, because you do own a part of Google, Amazon, Nvidia, all the biggest players in the space. Before we get into the earnings report and give a valuation of the company, I just want to share this article with you guys, because for the first time in decades, Google will next year not control the majority of the US market, the search market. They will still be the biggest player. They will own 48% of the share. But what's taking them down? Amazon. Amazon is growing much faster, and by 2026, they will own 27% of the market share, and Google is slipping. So Amazon doesn't have a search engine, but whenever somebody wants to go buy something, they usually go straight to Amazon because they know they have Amazon Prime and they're going to buy from there. So that is killing them. And I believe this is a hot pick right here, hot topic, that 5 to 15 years in the future, the search engines are going to die and just grow much slower and slower, and that AI is just going to take over, and that people will go to things like ChatGPT and Google Gemini, which is why they're investing so much money on it, to ask questions and find things. Right now, number one search engine is Google, and number two is YouTube. So Google has an enormous advantage and monopoly on this sector, which just gives them a huge moat. All right, ladies and gentlemen, thank you very much for clicking on this video, if I didn't mention before. And these are some of the red flags in Google that I really don't like. So one thing is that net payments of stock-based awards. So year to date, they spent $9 billion awarding their employees with stocks. And that is up $2 billion year. And if you look at this, stock-based compensation, $16 billion that they spent, same as last year, $16 billion. Guys, this is, I believe, 40% of the free cash flow of Google is just going straight into the pockets of the employees. I think that's ridiculous and unfair to the shareholders. But moving on, all the other things look really good. If you look at, they do pay a dividend. They paid $4 billion year to date in dividends, which I believe is only 17% of their free cash flow. So it's a safe dividend. They have been repurchasing stock. We can see that year to date, they spent $46 billion repurchasing stocks, which is amazing for shareholders. And I believe they do plan to continue buying more stocks. If you take a look at the balance sheet looks good. Cash did go down a little bit, but the total assets have gone up $30 billion, and that is because of the property and equipment. So I believe this is because they're building the data centers in US, in Greece, just all over the world, preparing to be the top player in AI and continue being the top player in the AI. And at the same time, total liabilities went down $3 billion. So this is one of the main things that I look for in a company, that the assets are growing much faster than the liabilities. Check mark, Google. One other thing I got to point out is the employees did actually go down, which I do like to see it. Now that they're using more and more AI for their own business, they can get rid of more people and replace them with AI. You're seeing the same thing in a company like Amazon. That amazes me. They have 750,000 robots working for them, labor jobs that they don't have to pay people by the hour, pay benefits and all these things. It's just great for margins, but bad for us. So if you look at this is a part of the income statement. We can see that all the revenues have been growing. The YouTube ads, the Google search engine, the cloud exceptionally has been growing to $11 billion. And we can see the other bets grew from 300 million to 388 billion, sorry. And the bad thing is the other bets are still unprofitable. That's why they're the other bets, not the main focus. Google Cloud, insane net profit, and same for the Google services. So overall, the earnings were very positive. Out of all the Magnificent Seven, they're one of the only two stocks that were actually up over earnings. I think they did a great job, and the CEO even said the momentum across the company is extraordinary. Our commitment is amazing. All this good stuff. Now let's get into the valuation. If you look at the insights right here, we can see gross margin 57%, not bad. Net margin amazing, almost 30%, 27%. The bad part is the stock-based compensation. So they're paying their employees 6% of their revenue and 40% of the free cash flow. I think that is just way too much, and I think it should go down. If you look at the financial health, they have almost $20 billion in cash. They have almost 2 times the assets than liabilities. They only have 7% intangibles as a part of the balance sheet. Intangibles are assets that mean nothing. They just look fancy on paper and make it seem as they have more assets. Revenue increased, and net income increased 41%. This is the cloud play, guys. The AI cloud has insane margins. And if you look at the analysts, next year projected earnings per share, 13% growth, revenue 12%. Very nice. All right, guys, when I'm looking to see if the company is cheap, now looking at some of these metrics, we can see that the company is not undervalued. Price to book, the average price to book is 5 times book value. Now it's selling at 6, 29 times earnings. It is selling at 22 times earnings, 28 times cash flow. It is selling 37 times free cash flow, 6 times sales, and it is selling 6 times sales. So this is, I would say, is a great company, but not the best price. I don't know if I should even call it a good price. It's an okay price. If you're bullish on this long term, I believe that this company will continue to grow and give you annual returns of 10% at least. I believe that is the bearish case. I think this company is doing a very good job and has a lot of growth in the future. 2 more things before I share some valuable information with you guys. The insider selling. So the insiders have been selling a little bit. Nobody has been buying the company, but the selling is not insane. The CEO sold $2 million worth, but he still has 2 million shares. He only sold 12,000. So maybe he just went to buy a cup of coffee or a new house. That is nothing to be scared of. And we can see there's no real selling from the institutions. And the last thing is the analyst predictions. So it is the average prediction is for it to be $200 per share within 12 months. And I think this is not bad. I think it's a good return, but I don't think it's just a great price for this business. And one thing I just want to share with you guys is everybody talks about diversification and how you should hold so many things, and I just disagree. I think you should put all your eggs in one basket and just watch that basket. Choose 3 or 4 good stocks that you believe will give you the best returns. And if you're sure you're going to get 20% return on one stock, why would you invest some of your money into a different stock that might not do it? Thank you guys very much for watching. I love you, and I hope you stick around and subscribe. That'd be awesome.